We'll start out with give you an opportunity to try and manage an ego, which is difficult for all of us as human beings.
Well, not for me, but for everybody else.
Well, I don't think that there is anyone in finance that has either had as big of an impact or as beneficial an impact on the world in history than the work that you've done and the work that Vanguard's done. I mean, if you want numbers, you know the numbers better than anyone, but $3.5 trillion under management, the lowest fees really by far in the category, a completely transparent set of tools and solutions that really teach somebody the principles of how to make money and how to think intelligently about investment. Who else has delivered that to that scale in finance in history?
Well, I mean, I guess I'd say not very many people, but for a very definite reason. And that is most people in this business are trying to make money for themselves rather than for their shareholders. And so they're not focused on giving the shareholder the best break. And if you think about it at all deeply, you realize that the stock market creates nothing. It reflects the returns earned by investors, by Investment America, the corporations of the country, the public corporations. And they have earnings, they pay out dividends, they reinvest the earnings in the business. That's where the value is created. You access that value through investing. So then the question is, corporate America has created this kind of value. What comes down to Investment America? And the answer is exactly what they earn, except that it's then the question is, how is it allocated between Wall Street, essentially the financial system, and Main Street, the people who invest? And the allocation to Wall Street is the objective of this business because everybody is in Wall Street. And what we should be doing is working, and what we have been doing here at Vanguard, is putting the investor first and innovating for the investor and not for ourselves. And trying to keep costs as low as we can, which is rock bottom. That's been the idea from the very beginning of Vanguard, because a mutual company doesn't have a private owner out there, or a public owner. And so we have no one to serve but the shareholder.
Can you think of an analogy in the business world or anywhere in life for the index fund and for the way that Vanguard approaches business? For somebody who's watching this and is very new to finance, is there a food business, or is there a leader, or is there a concept inside or outside of business that you think is a nice analogy for Vanguard and the index fund?
I don't think there really is. And the reason is that capitalism is about creating capital for the capitalist, if that's not too many capitals in one sentence. And they know they have to provide value. Adam Smith, 1776. The sole role of the producer is to serve the consumer. And in this business, it's dollars and cents. The more one gets, the less the other gets. And in an innovative company, you can create more and more value. You can reduce prices, but you're always making money yourself. That's what capitalism is, the incentive to get rich, if you will. And, I'm doing fine, but I don't own Vanguard. I've never owned a share of Vanguard. But I've been paid a nice salary, and a decent salary and nice bonus when I was running the place. So I'm not complaining, but I just don't have and never will have the kind of wealth that most people in this business have gotten because they charge their investors too much for what they're worth.
Can you really make it very clear what the mutual structure is for Vanguard? Just for somebody who doesn't understand it, is this a not-for-profit? Is it is it a collective? How's it set up?
Yeah, well, first let me contrast it with the typical mutual fund system. And the typical mutual fund system is an entrepreneur of some kind back at the beginning creates a company that forms mutual funds. And that company runs the mutual funds and gets paid for it. And that's the way any company starts. Nothing the matter with that. That is conventional. The difference in the mutual fund industry is when that little baby that needs all that parental care grows up, he doesn't need the care anymore. But some of these funds are 100 years old, almost 100 years old, and they still have that parent watching over them and taking money away. That's too long. The child matures, the child grows up, the child goes off on its own, and Vanguard's contribution is essentially recognizing that and saying, okay, you own the company. The incentives are all gone. You can do that pretty easily.
And again, who is you that owns the company?
You as the shareholders of our mutual funds.
You buy a mutual fund, and you are essentially a shareholder, an owner of Vanguard.
Yeah, just to give you each step, here's your fund. It's run by Vanguard, and you own Vanguard. And Vanguard also runs a whole bunch of other funds, and we allocate the cost among those funds. There are now probably 165 of them. So the costs are allocated depending on the fund's own cost, depending on competition, depending on fairness, things like that. So some judgment involved. But we still run this place for, give or take 12 basis points, 12/100%. And the average mutual fund specifically runs straight average, not weighted, about 112. So we save you 1% a year.
90%.
Yeah.
90% plus lower.
Right.
And what does that amount to over long periods of time? Because I think the average person who's maybe sitting down with their accountant sees, well, it's 1.12% or it's 0.12%. That's nothing. That's not going to be a game changer for me in my investment career. I might as well pick this one that I believe in most, even if it's 1 percentage point higher in fees. But what's the consequence of that if those two funds perform the same over 25 or 50 years?
Well, the consequence of that is that the one that's indexed, a dollar will produce about $30 at 7%. And the one that's not indexed, you're paying 2%. A dollar we created about $10 at 5%. That's the 7 minus the 2. So that means that you put up 100% of the capital, you've taken 100% of the risk, and you've gotten 33% of the return. And Tom, if that sounds good to you, I've got a bridge I want to sell you.
You got some real estate. And that can not, it's not a big extrapolation to say that can cost an individual who's regularly saving hundreds of thousands of dollars over their lifetime.
Yeah, they would probably pick a number I used, I think, in the Financial Analyst Journal, just taking this through to its conclusion, that a typical retiring investor putting in a certain amount a month and growing with salary and all would have maybe $450,000 at the 5% level in his retirement plan, and maybe $650,000 in the indexed plan. That's just the math. It is inarguable. There's no way around it. I call it, after Justice Brandeis, the relentless rules of humble arithmetic.
You cannot avoid the math.
You can't avoid the math.
Even though the industry has attempted to at times. But what I'd like to do is to hear you, if you could give the simplest Vanguard-like, index fund-like financial game plan for somebody who's over 50. Now, of course, each of us has all these individual factors, what decisions we've made, but the average person over 50, how simple? What is the simplest 10-minute solution or half-hour solution to getting Vanguard returns?
Well, I'll give you a simple solution, but the one thing we know about the average is, unlike Wobegon, there are a whole lot of people that are here and here and here, and the average is here. So in essence, nobody's average. You're all a little bit above average or a little bit less than average. You may have greater risk tolerance. You may have greater income requirements. You may have greater financial ambitions and are willing to take risks to accomplish them. But in all those cases, the lower the price you pay for owning the stock market and the bond market, the better off you are. Now, I have talked about a rule of thumb, and I want to underscore it's a rule of thumb, a place to begin thinking about having your bond position equal your age. So when you're 20, you'd be 80% bonds. Now that's a rule I would not dream
stocks.
of, 80% stocks. And I wouldn't dream of telling somebody with their first investment to be 80% in stocks. They should be 100% in stock. In the first year, maybe they'll put away $1,000. That's a drop in the bucket to compare to the value of their career and the value of what the investments will ultimately be. And by the same token, at least at these interest rate levels, I'll comment on that in a second, I wouldn't dream of telling everybody who was 87 why
you say
you're
that
laughing.
with pride. You say that with pride and enthusiasm.
To be 87% in bonds. I am not. I'm approximately 50-50. And so a lot depends on your own requirements. And this rule of thumb, first of all, very important for people to think about, and that is just about everybody that you're going to be talking about, every investor you're talking about, also has Social Security. And that has a capitalized value. What is that? The size of that asset pool you would need to create the returns you get in your monthly Social Security check, probably $350,000. So if you have $700,000 and $350,000 in Social Security, and you put 100% of your stocks into that, so it's $350 in stocks, $350 in this bond-like investment, and you're 50-50. So take that into account. If you have a pension from a local government or from a corporation that's not going to go bankrupt, I quickly add, you should add that in. What you're trying to do when you retire, which I am going to do someday.
I think you're going to fail at that. I think you're going to fail at that,
Would
Jack.
not be my first failure. But when you want to do that, you want to ensure a monthly flow of income. So don't watch the market. Just make sure your portfolio is producing income and will continue to produce income. So you get your Social Security check every month. You set up your mutual fund account or your index fund account for a monthly payment. You can do that. And just you want those payments to be stable, and with respect to Social Security and the fund alike, will grow a little bit over time. Dividends are an extremely important part of this. And ever since the 30s, which were a terrible time, early 30s and the Great Depression, when dividends probably got cut 75%, there's only been one period of time.
Not that long ago. Well, we're almost at 7
where
years
dividends
out.
were cut by, I think, about 25%. And that was from 2008 to 2009, when in the financial crisis, the banks had to eliminate their dividends. But it's a line like this with this one bump in it. So I think you can count on that under any foreseeable circumstances, to which I quickly add, there are a lot of unforeseeable circumstances out there.
But there is a lot of cash on the balance sheets of corporate America to suggest that the dividend is pretty secure.
Yeah, exactly. The payouts are low. They're probably running, the long-term payout is probably 65% of earnings, and now they're paying maybe 35 to 45% of earnings.
I want to go back to something you mentioned a minute or two ago about the importance of fees and really looking at what you're paying for that return that's being created by corporate America or corporations around the world, and then the fee that is the one interruption for you to actually getting that return. Would you suggest then that somebody who's going through and evaluating a mutual fund to purchase, and there are sites and services like Morningstar and others that have all of the ratings and reviews, and they tell you about the manager and all the rest, would you say that the best thing that someone could do would be to remove all of those factors and just rank them by fee and buy the ones that have the lowest fee? If you could do that without looking at anything else, obviously you'd end up with a number of Vanguard funds because your fees are average 0.12%. But is that a better methodology than the average person is using to pick a mutual fund?
Well, I'm tempted to say, and will say, ask Morningstar. They say that their sophisticated rating system works almost as well as simply rating the funds by cost.
Wow.
So they have entered the confessional booth with characteristics.
This has been happening for you over one decade after another. Which next financial provider is going to enter the confessional booth?
Well, the problem with that is this industry is run for the managers. They're the ones that put up the capital to start the management company. There's the ones that sell out to financial conglomerates. And today, we have among the 50 largest mutual fund groups, we have one mutual fund company. That would be Vanguard. We started the company 42 years ago, and Vanguard meant leader in a new trend. And we have failed as a leader. 42 years of success, and we have yet to find our first follower. Think about that. So they're going to have to eventually, money
Is that true? I mean, we were talking before about BlackRock. Isn't every fund company out there putting an index fund out there? Don't you have everyone following you?
Well, BlackRock has been able to do, specifically. The ETF, exchange traded fund business, is basically BlackRock, Vanguard, and State Street, and then it totally dwindles off. The traditional index fund business, the kind I started back in 1975, underwriting in 1976, is Vanguard has 80% of that market. Fidelity, struggling along, has 10, and 3 or 4 other firms do the remaining 10%. So, and people hide it. For example, T. Rowe Price has some index funds. They're very good, but they charge 1/4% a year plus 1/4% compared to 5/100ths of 1%. You could say they're overcharging the investor by 20 basis points, And I would say that's a way of looking at it. But what it really says is, if it's all the same to you, give us your active management business and don't buy our index funds, because they make more money at that. This is capitalism at work, as I've said before.
Isn't there a company that maybe is analogous, not perfectly to the zero sum that you outlined for finance, in a company like Costco? When I think of Costco, I think that that's the closest thing that I associate with Vanguard in business.
Sure. Well, we use Costco. My wife does.
You pay the flat annual subscription, and then everything else is marked down to.
But they still are a public company that wants to make money. And there's nothing the matter with that. I just try to get this through people's heads. There's nothing the matter with doing that. The problem is, in the financial business, value and cost are the reverse sides of the same coin. When you go into Costco or anything else you can think of, there's a value in your mind. You buy a Mercedes-Benz, you got a lot of value out of driving. Now, I don't know why anybody would get any great pleasure out of that, but maybe it's pride. Maybe they think Mercedes-Benz is a new star somewhere in the sky. I don't know. But you can't directly associate the cost with the value. But in the mutual fund business, it's how the returns are divided up between the marketplace and the investor. So this is a hard business to do it in without giving up your profits. Costco is not going to give up theirs.
That's the power of the mutual structure.
Nor is Target, which is my family name for Target.